So to recap, it's the high levels of debt, extremely low interest rates, the large wealth gaps and political divisions, and the rising world power, which was China versus this kind of overextended power being the US. So this was the most analogous to the 1930, 1945 time period. Of course, if we go back in history, we understand what happened. And that sounds really concerning.
Well, it is really concerning. And it's even more concerning when I went back to find the 500 years and the times that repeated over and over again. And what I found was there's a cycle. There's a big cycle. You know, you start a new world order. In 1945, we began a world order after the war. They decided how the world would be divided. They created the dollar as the world's reserve currency and so on. And then because there's so much fighting and then you've established a power that is a dominant power, you have a period of peace and prosperity. And then that gets extrapolated and it leads to more debt. Fear of bad times diminishes. Opportunities of borrowing and getting in debt, particularly if you have a reserve currency, because the world wants to save in that reserve currency. And that gets the country deeper and deeper in debt. And so you have those debt increases and you have bubbles, but you have prosperity. And bubbles are really fun. They're really enjoyable. They're great. But then you get to the point that there is a limitation to that. And those limitations become apparent when the central bank can't easily produce money and credit. That starts when you hit zero interest rates, because then you can't do it the same. Okay, then you go to that's monetary policy one is interest rate monetary policy. When that doesn't work anymore, you go to the next type of monetary policy, which is printing money and buying financial assets. But that financial purchases of financial assets and other things widen the wealth gap, because those who have financial assets do better than those who don't have financial assets. And you have a wider and wider wealth gap. And when you have that wider wealth gap, and then you have another downturn in an economy, that's a formula for a lot of conflict. And so that's what we see. So what does a central bank then do? If it taxes, it takes money out of the economy. That's not good. It's a problem. Mm-hmm. And if it cuts expenses, that's a problem. So the central bank always through history, this goes back literally thousands of years, the central bank or the entity that controls money then prints more money. Because think of it, we got all those checks in the mail and we needed to get all those checks in the mail, but you can't take it away from anybody. So where does it come from and what are the implications? So that happens for logical reasons. And it often happens at the same time as there's a rising power externally as a competitor, which is a challenge in that environment. So yes, it's one of those times. And I think people are not aware of it. Because I learned from my experiences that many things that happened in my lifetime that surprised me never happened in my lifetime before, but they happened many times before and in history. And that if I would go back in history, I could see that. The first time that happened was in 1971. I was clerking on the floor of the New York Stock Exchange. And Richard Nixon gets in front of the camera and says, we're not going to give you the gold, and devalues the dollar. And I walked on the floor of the stock exchange. I figured there was a big crisis. And I walked on the floor of the stock exchange and the stock market was up 4%, which was the most in a couple of decades. And I said, wow, that's surprising. And then I found out that Roosevelt did the exact same thing on March 5th, 1933. And what was done in those two times is the same thing that was done on April 9th of this year, when the federal government and the Federal Reserve decided to produce a lot more money and credit. So yes, you need these perspectives, and I want to pass that along, which is why I'm passing along that research on the LinkedIn piece.
Yeah, and it's always interesting, especially when you mentioned a mistake that 1971 on the floor of the stock exchange, what you thought was happening or going to happen, and it didn't. So you looked back in history and did this deep study. A couple of things I'd like to kind of double click on here, Ray. Monetary policy. You were just talking about monetary policy one, monetary policy two, and when you think about what's happened. First, you had the low interest rates. You couldn't go any lower. So then you had to purchase the financial assets. You mentioned it benefits the wealthier because they own the stocks. So I guess, are we exacerbating wealth inequality here? And do we need a rethink of monetary policy that's more targeted, that actually can help stimulate those who really need it?
Well, that's what monetary policy 3 is. So monetary policy 1 is interest rate based. Monetary policy 2 is the classic quantitative easing. Federal Reserve buys, or central banks buy, financial assets. Monetary policy 3, which is now what we are seeing and what is needed, is the production of that debt through government borrowing and the government direction of those checks to those who need it most. That's what we just saw. And that being then monetized by the central banks. And so we're in a new era, okay, of monetary policy 3, as I call it. Monetary policy 3 will mean that the free market will play a much less role in determining those capital market flows, that the government, as we come into the future, will be thinking, how do I get that money to those who need it the most? So it'll be a highly political decision, much more political than it was in the past, and that the central bank then will monetize those political decisions. So monetary policy 3 means there's that type of cooperation. So those are the two dimensions of the big change environment. You're going to see much more government influence and direction of where money goes, which will have a big impact on not only the economy, but of markets. You have to watch what they're going to spend their money on, and they have to watch where they're going to get their money from, what taxes and so on means. The government will play a bigger role. And it also means that there'll be much more debt that is monetized. And that has implications for the value of financial assets. It has implications for the value of the currencies and so on.